Good morning and welcome to today's webcast, SAS number 136 and the impacts on employee benefit plans. Before we get started, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and Lisa, I will turn it over to you to get us started.
Thank you, Emily. Hello, everyone, and welcome to our SAS 136 webcast. We're excited to have such a large group join us today, and I serve as the National Employee Benefit Plan Practice Leader, and so I'm excited today to introduce a couple of our team members that are going to be presenting today. These team members are partners in the firm with decades of experience in our employee benefit plan practice, and they both serve on our National Employee Benefit Plan leadership team with me. Our first presenter today is Catrina Blackwell, and Catrina is our Regional Employee Benefit Plan Practice Leader in the Southern California and Arizona area, and she's going to be giving you a wealth of information today on SAS 136. And we've also got Kory Hoggan, who is also one of our very experienced partners in our employee benefit plan practice. Kory leads our central region of our group, which is the New Mexico, Colorado, Texas, Kansas group. And again, going to be providing a lot of good information. I mentioned these individuals have decades of experience, and our practice here at Moss Adams is a very experienced practice. So we're excited to bring all of that knowledge to you today in regards to how SAS 136 will impact your plans going forward. We audit approximately 1,900 plans here at Moss Adams of all different types of employee benefit plans, which makes us the 4th largest service provider in the nation in regards to the plans that we audit. So again, excited that you're all here today. And with that, I'm going to turn it over to Catrina.
Great. Thank you, Lisa. Good morning, everyone. We have a lot to cover today in a very short period of time, so I'm going to dive right into it. Statement on Auditing Standards number 136 was issued back in 2019 and is titled Forming an Opinion and Reporting on Financial Statements of Employee Benefit Plans Subject to ERISA. Now, even though this is an audit standard, it does have a lot of effects that management has to adopt and plan sponsors need to really pay attention to, because there's going to be new requirements for management to take responsibility in certain pieces to comply with SAS 136. So the new audit standard adds new performance requirements for benefit plan audits. It only applies to those plans subject to ERISA, and it also changes the form and content of the audit reports. It's effective for periods ending on or after December 15th, 2021. It was originally set to be effective in 2020, but it was postponed a year. So we're now into that effective date. So basically, SAS 136 includes new requirements in all phases of our benefit plan audits, including all of these areas listed here, which we will cover in this hour. But first, we are going to kick off our first polling question. And remember, you need to answer these polling questions to get CPE. And we just want to get an idea of who's in the audience. So tell us who you are. Are you a benefit plan auditor like myself and Kory and Lisa? Are you a plan sponsor? Are you a service provider? Or none of the above, but you just want to know more about SAS 136 for some reason?
Give everyone just a couple more seconds here.
You want to make sure you get your answers in so you get your CPE.
Okay, I'm going to go ahead and close it out and we can take a look at the results.
Okay, wow. So we have a lot of plan sponsors. That's very exciting, because this will be so nice to go into the audit season, having plan sponsors knowing what's expected and what these changes are all about. So very glad to see that. Just wondering.
Katrina, I'm kind of concerned about D. We had 26% of the people that just want to know more about SAS 1.
That's an interesting group. I'd like to know more about that. Okay. So SAS 136 includes some new engagement acceptance requirements. So you'll see some changes in the benefit plan audit engagement letters for the 2021 plan year audits. The new engagement letters will now include an acknowledgement from management that they understand their responsibility for certain things, such as maintaining a current plan instrument, including all of the plan amendments. They will have to acknowledge responsibility for administering the plan and determining that the plan transactions are properly presented and disclosed in the financial statements. Also, for maintaining sufficient participant records in order to determine which benefits are due or will become due to participants. Now, I know that a lot of these things are outsourced, but management has to understand and acknowledge that they do have ultimate responsibility for these things. Also, acknowledging responsibility for providing a substantially complete Form 5500 before the audit report can be dated or issued. And if you're performing a Section 103 audit, which was formerly known as a limited scope, management will need to determine that that type of audit is appropriate under the circumstances. And we'll talk more about this a little bit later. Okay, on to risk assessment. SAS 136 requires the auditor to consider relevant plan provisions when designing and performing audit procedures. The latest plan instrument and all the amendments that go to the plan instrument are essential in understanding the plan and then identifying relevant plan provisions. This is important, obviously, because all financial statement amounts are basically determined from those plan provisions. So, for example, the auditor needs to gain an understanding of contributions, what's allowed or what's required by the plan before designing audit procedures to test those contributions. Now, we've always tested contributions, but this is basically looking at the plan document and seeing, does the plan allow for employee contributions? Does it allow for employer contributions? Is there a maximum or a minimum to those contributions? Does it allow pre-tax or Roth? And then also employer contributions. Are they allowed or required under the plan? Are they required or discretionary? Is there an employer match? That might we may design our procedures if there's a match to test employee and employer contributions because there's a matching together. We may shift our testing if there's a maximum, say that the plan allows for a 10% maximum contribution. We may take a look at the whole population and see that, is there anyone that sticks out that's over that 10%? So it's a little bit of a shift from going the financial statements and testing those financial statement numbers to looking through the plan document and assessing where there's risk for error or misstatement. And is there a profit sharing contribution? Profit sharing contributions would be calculated differently than an employer match. And how is that done? Are those done in payroll or are they done on an Excel spreadsheet? So there's a lot to assess as far as risk when you look at the plan provisions and then again how they're played out. For eligibility provisions, are there different eligibility provisions for employee contributions than there are for employer contributions? So say you're eligible for employee contributions immediately, but employer contributions come a year down the road, you're eligible in a year. Is there risk there when there are two different eligibility provisions? Does a plan have auto enrollment? Is eligibility based on job classification? So some may have tiered job classifications where some are eligible in a month or some are eligible in a year. So those are things that we want to look at when we're assessing risk of plan provisions. Benefit payments are another part that, how are benefit payments calculated? Is the formula complex? Is there a vesting schedule? Are the benefits based on compensation or years of service? So that would drive our audit procedures differently in assessing the risk of how that is done. So all audit procedures would be designed according to our review of the plan document and assessment of risks for classes of transactions, account balances, and disclosures. We would expect some sort of work paper that shows the consideration of those plan provisions and what are relevant plan provisions and how that links to our testing procedure. So that's a little bit of a change that we're going through. Now, one thing is that it would be really rare that an auditor would determine that there are no relevant plan provisions to be tested. So don't think that that's going to happen very often. If that rare instance were to happen, then the auditor is required to document the consideration in reaching those conclusions. So there has to be a lot of thought process into how you come up with no relevant plan provisions to be tested. SAS 136 specifically requires that the auditor obtain and read the most current plan instrument for the audit period, including the amendments, as part of obtaining an understanding of the plan sufficient to perform risk assessment procedures. Also, as part of risk assessment, the auditor should consider whether management has performed the relevant Internal Revenue Code compliance tests, including but not limited to discrimination testing, and that plan failures have been corrected or are in the process of being corrected as needed. The auditor should also evaluate whether the prohibited transactions identified by management or as part of the audit have been appropriately reported in the applicable ERISA required supplemental schedules. If the auditor determines that the prohibited transaction has not been properly reported, then the auditor has to either modify the audit report or add an other matter section to the report, depending on how material and what the effect is on the plan. So if there are prohibited transactions, these need to be discussed between the auditor and plan management to see what the effect is, how material it is, and how to be reported. With that, we'll go into another polling question. So now that I've given you a little refresher of what SAS 136 is, how familiar are you with it? Have you read the whole standard? You've only seen highlights. You don't know anything about SAS 136. You've heard about it, but you don't really know anything about it. Or are you just figuring out this is about 136 and what does that mean? I'll give you a few seconds to answer.
Just a few more seconds right, let's take a look at the results.
Okay. A lot of people, most people, don't know much about it. Maybe you've just seen or heard a little bit about it, so that's why you're on this webcast. So that's great. Okay, so we're going to move on to reportable findings. So when the audit work performed results in the identification of items that are not in accordance with plan provisions, what do we do? Well, the auditor should evaluate whether they consider them to be reportable findings. SAS 136 defines reportable findings as matters that are one or more of the following: an identified instance of noncompliance or suspected noncompliance with laws or regulations, a finding from the audit that is significant and relevant to those charged with governance in their oversight role, so something that we want to bring to the attention of those charged with governance, or an indication of control deficiencies identified during the audit that the auditor feels is important enough to be brought to management's attention. So those are what we consider now reportable findings and should be in writing. So the auditor should communicate in writing in a timely manner the description of the reportable finding, and we want that to be sufficient enough to enable those charged with governance, obviously, to understand the context of that finding and what that means to the plan. So there as a result of this, you just may see more communication, or hopefully you will see more communication of just plan provision issues or compliance issues that are now in writing that maybe before were not in writing because they didn't rise to the level of significant deficiencies or material weaknesses. Okay, with that, Kory, I'm going to turn it over to you. Kory, are you there? Did we lose Kory?
I think we might have dropped Kory.
I know he was having some problems with mics earlier.
Let me see if I can reach out to him and see what happened. Thanks everyone for bearing with us here.
I can kind of start going through these, and then we'll, if Kory shows up, I'll turn it back over to him. So basically, ERISA Section 103A3C audits is a new term that everyone's going to see in the engagement letters, the rep letters. This is what was formerly known as limited scope audits. Now, when management elects an ERISA Section 103 audit, we're going to call it that for short, then management should acknowledge and understand its responsibility for determining that such an audit is permissible under the circumstances. So this is kind of something that only the auditors did before, and now will be put on management to make sure that they understand and acknowledge that it is permissible that this plan can have this type of audit. The investment information is prepared and certified by a qualified institution. So management needs to determine that those investments are held with a qualified institution, and that means a bank or a similar institution, an insurance company that is highly regulated and supervised, which is how they become a qualified institution, and that the assets are held with the qualified institution. Any assets held outside of the qualified institution is not covered by the certification and therefore would need to be audited.
And can you hear me now?
Yes. All
right. Sorry, everyone. They're trying really hard to shut me up around here, but my voice will be heard. As Catrina was mentioning, one of the key aspects of SAS 136 is that limited scope audits are going away and being replaced by these this new audit that's defined in the standard ERISA section 103A3C audits. And don't get too hung up on that name. You know, I'm fairly confident that the industry is going to come up with an acronym or something that we can use. And for purposes of my presentation, I'm going to call them 103 audits today. And about Moss Adams audits about 1,850 plans, and about 90% of those are audits formerly known as limited scope audits. So this will impact a lot of you on the call today. Catrina walked through what these certifications are. You know, it's interesting. I started auditing plans back in 1995, and 27 years ago. And one of the first national trainings, conferences that I went to, the speakers were all saying, limited scope audits are going away. Don't tell your clients this is not a permanent option. And so I'm real excited about this. This is really kind of final fulfillment of an ancient prophecy that we're finally getting a standard that's redefining limited scope audits. And the great news is that it's keeping the aspect of these audits that we really like, both as auditors and plan sponsors, and that is that we can still rely on this certification for investments to reduce our audit work and make these audits more efficient. The second good news part is that it's doing away with the disclaimer on the opinions, which was a modification to the opinions that made these a little bit unusual. And disclaimer is kind of a bad word in certain circles, and it's doing away with that and creating an avenue where you can have an unmodified opinion on what was formerly a limited scope audit, a 103 audit now. So what's changed with these audits? And I'm going to focus on these first two bullets here. Under SAS SAS 136, I almost said SAS 103. SAS 136 puts the responsibility for evaluating whether an audit qualifies as a 103 audit on management, on the plan sponsor. And you know, you say, well, geez, that's the way it is now. But you know, really the way it works now is auditors get a copy of your trust statement. They look at it and they say, hey, geez, it looks like you might qualify for a limited scope audit. And management looks back and says, oh, okay, let's go with it. And this standard really changes that now. It's saying, hey, management is responsible for assessing, making that assessment. It's they're going to be in the rep letter now, which we'll cover in a minute. You need to make a representation of that. And it's actually in the audit opinion now, where it says management has assessed this and made the determination that the plan qualifies for a 103 audit. So the burden is really on management to understand this. And we've put a link to a tool in the chat. It should be out there. The AICPA has put a really good checklist together that you can click on and work through. It's a series of kind of yes, no questions that really will help confirm whether you are qualified to have this type of audit. And then the second bullet here is really the auditor's role in this is to make inquiries of management, to make sure that you understand the type of audit that's being performed and that you're going to make that representation, that you understand the certification that's been provided. So we're ready for our third polling question here. What is a qualified institution? This goes back to the slide that Catrina talked about. Bank, trust companies, and insurance companies. B, record keeper. C, investment manager. D, who wrote this question? Donut shop, and that's the trick.
That was specially for you, Kory.
That's the trick question. That's the trick answer here, because we know that a certification from a donut shop would trump everything.
Some of those certified donuts.
All right, just a few more seconds on this third polling question. Okay, let's take a look at the results.
All right. Well, A is clearly the answer, and 85% of you got it right. The donut shop held strong at 2.3%. At least I know that George is on the call. That's great. So I mentioned a minute ago that management is going to be responsible for understanding the certification and making it qualified. Let's go through what's involved there a little bit. The first qualification for a certification is that it's prepared and certified by an institution that's qualified to do that, a bank, insurance company, or qualified trust. And, as auditors, we see certifications that are printed off the internet, and they come from all kinds of people. Typically speaking, an investment broker, a local TPA, they're not qualified to provide that certification or to sign one. It needs to actually come from the custodian or the bank. And along with that, it needs to be signed by somebody that's authorized to sign it. Executive, somebody at the bank that's in a position to sign that. It can't be a blank certification that's just signed by anybody that represents the plan to you. The third bullet's kind of interesting because this is something that we're seeing a lot more of as auditors. Does the certification really cover all the investments in the plan? And what we're seeing now is a lot of certifications that are carving out participant loans. Maybe they're carving out guaranteed investment products that are handled by a separate insurance company, self-directed brokerage accounts, those types of investment options in the plan. So make sure that your certification is covering everything, because as auditors, we can't split the audit and do a 103 audit on half the plan and a full scope audit on the other half of the plan, or non-103 audit. It has to go one way or the other. So making sure that your certification is complete. The key words in a certification that you see are completeness and accuracy, that it's in accordance with the ERISA regulations, and that the investments are complete and accurate, and that it covers the entire year. Again, another thing that we run into as auditors is sometimes these certifications, especially in those years where you're changing custodians perhaps, that's definitely one of those things you want to watch out for. When you've transferred the plan assets from one custodian to another during the year, making sure that you have certifications that cover the entire year. Plans that are held in master trust, another consideration. A lot of times certifications don't cover that allocation of investments down to the plan level. So it's something real important. I audit a number of master trust plans that aren't able to get that level. The custodian is willing to certify the whole master trust, but not the allocation down to the plan. So we're not in a position where we can do a 103 audit there. And the next bullet's very critical too. I alluded to that before, but you run into this agent forwarding on certifications where they may have a passive trustee for the plan. Maybe it's an investment broker, and they've engaged another trust company to act as the trust company, and this broker is signing as an agent on behalf of that trust company, or somebody else is. And if there's that kind of connection or agreement involved, you need to get a copy of that agency agreement to show that legal connection and the authority to be able to sign as an agent on that certification. And finally, especially if you have investments in alternative investments, in level 3 investments, limited partnerships, hedge funds, those kind of investments, a lot of times there is a lag in the valuation of those, say a 90-day lag. So you need to make sure that the certification is covering the fair value of those investments, not just what's reported in that custodian report, but through the fair value measurement of those investments if you have those types of investments.
Kory, I'm gonna stop you for just a second. And along those lines, there is a question related to, and this is a common issue, when management discovers that the leveling provided in the trust statement and related to the information received maybe isn't accurate with their assessment. And is there any impact or changes that they should consider under the new requirements as to sensitivity in making adjustments related to the fair value leveling?
Absolutely, and that's a really good question, actually. Thanks for interrupting me. I thought you were going to say my microphone wasn't working or something. I was a little nervous there. I think most of the auditors on the line can agree that usually the leveling tables that we get from custodians are inaccurate more times than they're right. And the good news is the certification really covers the valuation of the investments and the earnings on the investments. The leveling table is an accounting standard that's separate as far as how those are classified and reported on the financial statements. So to answer your question, yes, I think management needs to understand those leveling tables and those fair value representations are representations of management and have been since that standard was issued. So management needs to understand that, but don't feel like you're locked into what your custodian says where they should be. Or work with your auditor, make sure that you're reporting accurately, and it shouldn't affect that certification. Hope that answered the question. I want to move into representations. I alluded to a couple of new management representations that are going to be required under 136. Again, when we talk about written representations, we're talking about that management representation letter that auditors ask for at the end of the audit. Typically, it's prepared on letterhead and dated with the audit report date. SAS 136 is going to expand that letter, require new representations from management, require management to sign and on new items. The first item is that management has provided the audit team with the most current plan instrument, plan document, or plan agreement for the audit, including all plan amendments. We don't have anything in that letter now or previously that is that specific related to the plan agreement. And I imagine now that new representation will probably detail, we have provided through amendment number 2 dated December 15th, 2020, and you would sign off on that. So it's going to require a little more scrutiny and assessment on whether your plan document is updated and that you've provided the correct information. The second item that we've noticed that is new is management's responsibility for administering the plan and determining that all the transactions are presented and disclosed in the financial statements in conformity with plan provisions. So it's putting a little more responsibility on management to really understand those footnotes and make sure that they represent what's in your current plan document. It's we run into those kind of questions quite a bit. Sometimes plans stray from the plan document and start doing things in practice that are a little bit different. And this isn't going to put the burden on the auditor to really detect all that. It puts more responsibility on management to understand those footnotes and make sure they're representing what's in your plan agreement. The third one's interesting. Representation that management has the responsibility for maintaining sufficient participant records for benefit payments and for what will become due to participants in the future. So we're talking about here are your payroll records, your census data, records of contributions, your loan records, withdrawal information, if people have taken pre-retirement withdrawals from the plan. Now, this doesn't mean that you have to have a big filing cabinet on site full of paper. It can be electronic. It can be, if you're with a record keeper that maintains this information online and you're able to access that information easily and get it without tremendous burden of getting access to that information, that meets the requirement. But again, it's just another representation that you have access to that information, that you maintain those records.
Yeah, and Kory, I would just like to jump in and emphasize, I know I have many conversations with my clients about looking at that service provider SOC 1. You know, so much of this is outsourced to service providers, and plan sponsors rely on that, but really reading that SOC 1 and making sure that there's not some kind of an error called out or a modification to that report is really important in, you know, their assessment on how those records are being kept.
Yeah. And, you know, SOC 1 reports used to be called SAS 70s. I don't know, about 10 years ago, they issued a standard back then, and they changed the name of them to SSAE 16 reports. And we all grumbled and said, that's way too many syllables. And before we knew it, we started calling them SOC 1s, which was a lot easier. So when you start complaining about this long name for the 103 audits, just remember that and just have confidence that we're going to come up with a shorter name. Anyways, I digress. Anyways, let's go back to our representations. I mentioned earlier, management's going to be responsible to include in the representation letter and sign to that they've determined that the 103 audits are permissible and allowed in this situation, that your certification is a qualified certification, was prepared by an appropriate institution, and that it meets the requirements to be a proper certification. So that is another additional written representation that's going to be provided. So with that, let's move into the changes that are going to happen to our reports as the auditors. And I know in general, the standards requiring new report wording that is more comprehensive, and the reports are definitely longer. The audit reports are definitely longer. So if you prepare your own financial statements and you're used to saving spaces for the audit report to be inserted, where you used to save 2 pages, I think now you're going to need to save 3 or 4 pages, depending on what type of audit it is, because there's a lot more detail in these audit reports. Interestingly enough, the new audit reports, especially for the 103 audits, include a lot of these management representations that we just talked about, go right into the audit report as well, on top of your financial statement, saying that management has the responsibility for determining that the plan met the qualifications for a 103 audit and the certification is accurate. And those types of representations are right in your audit report in the financial statements. So let's talk about the non-Section 103 audits first. These are the audits formerly known as full scope audits, which would likely impact about 10% of the plans we audit. For various reasons, they don't qualify as a 103 audit. So the standard changes the order and detail of these opinions as well. Interesting to note that the order in the audit reports is changing all around. The prior reports really started out with kind of a scope paragraph that's saying what years were audited, what name of the plan, all that kind of stuff. The new reports are starting right out with the auditor's opinion, right at the get-go. The first paragraph you read, first 2 paragraphs you read are going to be our opinion on the plan, and then it backs off. And, you know, normally that was somewhere on the top of page 2 of the 2-page opinion is where you finally got to the opinion. Now it's right at the beginning. And then it backs off and talks about the basis for that opinion, that the audit was performed under generally accepted auditing standards. There's a statement of our independence as your auditors now that's right in the opinion that wasn't there before. There's additional language in there about going concern and management's responsibility for assessing the going concern of the plan. And to recap, going concern means that there aren't any risks or discussions about terminating the plan or the plan becoming illiquid within the next approximate 1 year time frame. So if there were going concern issues, of course, as now, there would be wording in the opinion in most cases to report that. And as I mentioned earlier, right in the audit opinion is management's responsibility for maintaining current plan documents, for administering the plan, for taking responsibility for plan transactions being presented and disclosed accurately and completely, maintaining participant records, all those things we just talked about. Those are not only going in your management rep letter, but they're also going right into the audit opinion, which is a pretty dramatic change. And then the auditors, not to be outdone, the auditor's responsibility section is also longer now. There's a lot more detail on what we do as your auditors and our responsibilities. And then finally, there's a section on supplemental schedule that really lays out more about what the supplemental schedules are and the fact that we as auditors are issuing on a non-103 audit, we're issuing an in relation to what we call it as an in relationship opinion, that the supplemental schedules are accurate and complete in relation to the audited financial statements. Things get a little more interesting with the new Section 103 opinions. Again, the audit opinion has been moved up towards the top of the opinion, but there's a section at the beginning that really defines what 103 audits are. There's a lot more wording around what a Section 103 audit is, and then that management, again, has determined that the plan meets the qualifications to be a Section 103 audit and has received a certification from a qualified institution to do that. The auditor's opinion, and this is the great news about the whole standard, is it's no longer a disclaimer of opinion. It's now qualifies to be an unmodified opinion, a clean opinion, which is the highest level of assurance we provide as auditors. Before, it was this disclaimer, which a lot of times if you showed it to the CFO or a finance person that wasn't real familiar with benefit plan reporting, they would really frown at that, because disclaimers really is kind of has a negative connotation in the accounting world. But we'd always take time to explain that under the prior standards and ERISA regulations, this disclaimer was allowed and really quite common. But now we don't have to have that conversation anymore. It is an unmodified opinion under this new defined type of audit, this Section 103 audit. So there's a lot of verbiage in the new opinion around that, about what a 103 audit is, about management's responsibility for that. There's, again, the going concern language is in this report as well as reporting out on management's responsibility for the administration of the plan and the plan document. The supplemental schedule is actually very lengthy for 103 audits. It's 3 or 4 paragraphs long and almost takes up an entire page in itself, just talking about how the supplemental schedules fit into the 103 audit framework and the level of assurance that's being provided on those. With that, let's move into our final polling question.
Kory, I think we lost your audio. Well, while Kory hopefully resets here, we'll give everyone another few seconds to respond to our polling question. right, let's go ahead and take a look at the results, and maybe Catrina can jump in here.
Okay. Yeah, so there is this new requirement to provide the auditor with a substantially complete Form 5500 prior to us dating our report. So we were wondering, do you expect that there will be delays? And it looks like it's kind of spread out, right? We're not sure what to expect. But I think the good answer would be stay on top of the 5500 preparers. Just, they know of these requirements too. Everybody's going to have the same problem, but a substantially complete 5500 should not be a big ask, at the tail end of the audit before we date our audit report. So.
All right.
Okay,
Can you hear me now?
Oh, yep. Hi, Kory.
Thanks again, Catrina. I don't know. I get up
You're just
early,
keeping me on
I
the
head
toes.
into the office, I put on my sport coat and plug in my headset, and, you never know.
You're just making sure I'm not falling asleep or something over here.
The world we live in. Hey, so the final section we have today is going to cover 5500 reporting. There is a more language in SAS 136 about the 5500 and our responsibility as auditors and responsibilities of management to get a substantially complete 5500 before we are able to issue an audit report. And that doesn't change too much from our practice right now. We usually attempt to get a 5500 draft, but as you know, in practice, at times the 5500 drafts aren't ready sometimes if you have a separate 5500 prepare, and sometimes as auditors, we just get a copy of the Schedule H, or we aren't able to get a Schedule SP or something, and are able to still issue the report to meet a deadline or something. 136 puts more teeth into the requirement that as auditors, we need to get a copy of a substantially complete Form 5500 prior to putting a date on our audit report and being able to issue a financial statement on the plan. So in many cases, that might mean working with your record keeper and your 5500 preparer earlier this spring and making sure they understand the timeline. And a lot of times those 5500 preparers might be waiting things from the plan sponsor to be able to complete that draft. Having your non-discrimination testing completed, or getting information from the actuary if it's a defined benefit plan, for example. So really get out in front of that this spring. Make sure that the 5500 preparer gets the information they need to complete that draft, and know that we as auditors really do need to see a substantially complete 5500 before we can issue. The second big change that's kind of been strengthened is this more definition around what our responsibility is with the 5500 and the procedures we've performed and the results. We're the financial statement auditors, where our audit scope is really tuned to the financial statements of the plan. We're not auditing the 5500 itself, but we are required to make sure that the 5500 agrees with the financial statements, that the audited financial statements support the disclosures and amounts in the 5500. So in accordance with that, the standard really states that the two need to agree. If there's material inconsistencies identified, one of them needs to be changed to have those amounts agree or to be able to be reconciled. And reconciliations really are only allowed in those cases where there are differences in the 5500 reporting rules and GAAP. If you can't issue a 5500 on a cash basis without, that excludes your contributions receivable and those types of accruals, and then have your financial statement on accrual basis on an ongoing basis, you really need to iron out those inconsistencies and make those two documents line up with each other. The way this is out of the 5500, the Schedule H Part 3, this is where the auditor's opinion is reported in the 5500, and This was actually changed last year. We got a little bit of a sneak preview of SAS 136 last year, and that wasn't intentional from the DOL. That, like Catrina mentioned at the start of the session, the intent was that this standard was going to be implemented in 2020. And then COVID hit and they delayed implementation. But the 5500s that are set up by the DOL, the IRS, had already been printed. The forms had already been finalized. So they went ahead and rolled out the new Part 3 last year. And I know there was a lot of confusion. The standard wasn't effective yet. So even we as auditors were questioning, why would we check the unmodified box when it's clearly a disclaimer? The good news is, as we mentioned before, I want to try this out. Yeah, it works. Box 1 is checked. Assuming you've had a clean audit, there's no modifications to your report for your opinion for other things, or no need for a disclaimer or qualification for other purposes, you would check the unmodified box here, whether it's a 103 audit or a non-103 audit. So in all cases, assuming everything else in the audit is clean, it would be an unmodified opinion, and that box A1 would be checked. Moving to number 2, if you did get a 103 audit, the audit formerly known as a limited scope audit, you would check box 1, which is the first highlighted box there. That's the box that it was a DOL regulation 2520.103-8 audit. And then likewise, if it was not a 103, if it was a non-103 audit or what was formerly known as a full scope audit, you would check box 3. So on this line, they're both highlighted here. You wouldn't check both of them. You would check the first one if it was a 103 audit, box 3 if it was a non-103 audit. And with that, I think we've reached the end of our prepared presentation. I've seen a ton of questions come in through the Q&A, and we have a few minutes left here to talk through the questions. If we don't get to them all, and I don't believe we will in 5 or 6 minutes here, we will be taking these offline and we'll respond to each question in some type of alert, especially if there's more than one question that's related to each other. We'll get something out within the next couple of weeks and respond to those questions.
Kory, there is a question on the certification that's come up a couple of times, and it relates to if the plan holds various assets that are not included in the certification, whether that's self-directed brokerage accounts or other assets. How does that impact the plan's ability to have this type of audit completed?
Well, I think the first answer would be that you can't split the audit. You can't do a half 103 audit and a half non-103 audit. But having said that, I think you would assess materiality of the non-certified assets. First of all, if plan loans are not certified, but there's only one plan loan outstanding, certainly there's some judgment involved there and discussion that you could have with your auditor over that. I think it's really something to assess on a case-by-case basis, but I think looking to your custodian or the custodian of those assets that aren't certified and seeing about possibility to get coverage from a certification would be important as well. I don't know, Catrina, would you add anything to that?
I think a lot of it specifically talked about self-directed accounts, and I know that sometimes you can have, for example, your main assets are with Empower, and then you'll have some assets that are sitting in Charles Schwab. So just look for a second certification maybe for those self-directed assets. It doesn't mean that those are specifically not covered by a certification, and we would need 2 certifications, and then that would go into the assessment of whether that company is able to certify. So yeah, there would be a second certification for that. Sometimes we also run into, there might be some of these investments that we know on the trust statements, they may be recorded for the quarter prior because they're in arrears. So the investment manager might have an updated price and the trust statement says last quarter's price. It's really not materially different, but that's something that we'd have to take a look at. And again, management would have to assess what goes on the financial statements, and we're kind of auditing that at that point because it's not covered in that certification, or it's not accurate.
I think as auditors, every year we run into certification issues. All of us do, and sometimes it's timing where the assets were transferred out of a trust to a new trustee on the 29th of December instead of the last day of the year or something. But one that's very common, goes in with what you're saying, is there's a lot of plans out there that primarily offer mutual fund based investments that are certified by trustee or custodian, but then they might offer a guaranteed investment contract product through a separate insurance company for their retirees or whatever. And the primary custodian will not certify to that insurance product. So it's, in a lot of cases, we have been able to reach out to the insurance company, the company that markets that product, and been able to get a second certification, which kind of saves the day and allows for a 103 audit to be performed.
Thanks, Kory. Thanks, Catrina. We also have, I think this is a good way to end the session, a question in general on ultimately, and this is a very general and broad question, but what do we see as far as changes in auditing procedures? What can plan sponsors expect to feel? Is it going to feel different? And how might that impact audit fees?
A lot of questions there. That's the elephant in the room right there, huh? The audit fees.
Well, we don't expect them to go down, do we, Kory?
I think ultimately, from my perspective as the practice leader, we're seeing, we are taking this opportunity to look and make sure that we are conducting our audits in accordance, obviously, with the new standard. And so we are going to be taking a different look at things and looking at relevant plan provisions. Frankly, we've always done that, but we may have a different point of view, and our samples may be slightly different than what they've been in the past to make sure that we are meeting that auditing standard. And so there is a little bit of growing pain, obviously, with 136 and the implementation. Obviously, we've got new reports, new management letters, new engagement letters, and then all of our auditing documentation has to change within just to make sure that we're meeting the standard, and talking with management again and getting all those representations. So we do see there will be some changes and some increases in the hours, especially in this first year of implementation. So we do expect to see some increases related to that. And Kory,
my first take on this. I'm sorry, Lisa.
Go ahead.
My first take when I first read through this standard was, and started hearing some of the various trainings on it, were our audit approach up to now was largely dictated by the Department of Labor. It was really more of a compliance audit. The department would say, hey, we want you to spend most of your time testing the timeliness of remittances, or we want you to make sure that you look at one rollover. We want you to make sure you look at participant investment elections. It was really driven by the DOL and compliance, and then this standard was issued by the AICPA, which is the professional accounting group that defines it's our rule book as accountants, and they kind of slipped into the driver's seat a little bit. They're saying, no, auditors, you're not just following the DOL rules anymore. You really do need to take a risk-based approach to doing these audits from the top down. So it provides the audit team with a little more professional ability to assess where the risks are. We might need to increase sample sizes on some things, more than just looking at 3 people. We might be looking at more. But on the other hand, we might not have to test as much on some of this stuff that we were doing in the past just to check the box. So
absolutely. Thank you, Kory. That's a great point. Thank you, everyone. Today, I'm going to turn it back to Emily. We're at the top of the hour.
All right. Thank you so much, Lisa. And thank you, Catrina and Kory, for a great presentation today. Thank you all for bearing with us as we worked through some audio issues. We certainly still covered a lot of material. We also had many questions that we didn't get to respond to. We will be doing our best to follow up with you after the presentation. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. And I'll be keeping the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.
Thanks, everybody.